Okay, well, welcome everybody. I think it's about time we officially kick off because we've only got an hour with you. And as you can see, there's quite a few experts on today's call who are willing to share their knowledge, and really looking forward to hearing your questions and having a good discussion this afternoon. So thank you so much, everybody, panelists and attendees, for joining us today on our webinar. We're going to be looking today at understanding agricultural digital financial services for climate resilience, something that actually should be really key in many of our hearts. And I'm really looking forward to hearing from our experts today. We've got Sonia, David and Abhishek on the call with us today, who are going to give a short presentation before we move into the Q&A. And I'm also delighted to be joined by Samke today as well. She, like me, is Deputy Director at Digital Frontiers Institute. And she's making my life easy today because actually she gets to do the moderation and I get to sit back and enjoy. So it's a pleasure. Thank you very much, the four of you, of joining today.
Thank you, Sarah.
Thank you. Just a couple of housekeeping things before we get going. A quick reminder that we are recording today's call. So if you do happen to have any internet connection issues, or more importantly, really enjoy today's session, you'll be receiving a link to the recording in your email inbox in the next 24 to 48 hours. So please feel free to share that link with other colleagues of yours who you think may be interested too. And also just a reminder, we want to hear your questions. We've got time at the end. We've made sure that there's going to be plenty of time to hear from you. So please, if you sort of use the Q&A function, not the chat, please, if you can use the Q&A function, that will help us keep a record of all your questions and help us get round to answering as many as we can live on today's call. So without further ado, let me stop talking and hand over to Samke so we can get today's session started. Over to you, Samke.
Well, good afternoon, good morning, and good evening, wherever you are today. Today's webinar, we will be addressing the pressing need for climate resilience. We will define climate resilience and climate finance and provide an overview of the different instruments and sources. To kick off our conversation, we will start with Sonia. Sonia is an insight manager with the GSMA's Agri-Tech team. She provides insights and analysis on that is instrumental to build the case for digital financial inclusion of smallholder farmers. And she happens to be one of our certified digital finance practitioner candidates. So she is studying the CDFP, and she will kick us off today with a great overview. Over to you, Sonia.
Thank you very much, Samke. I'm gonna share a few slides that should be working now. Great. So thank you very much for DFI for organizing this session. And as Sarah said, the need for climate resilience is very urgent and pressing and in front of all of us. So it's a pleasure to be here speaking about this topic today. First and foremost, for those of you that are not familiar with the GSMA, so the GSMA is a global trade association of the mobile industry. Members of the GSMA are more than 750 mobile operators and almost 400 companies in the broader mobile ecosystem. Within the GSMA, there is a not-for-profit unit called Mobile for Development, positioned at the intersection of the mobile ecosystem and the development sector, to stimulate the digital innovation that deliver both sustainable business and large-scale socioeconomic impact. The GSMA Agri-Tech program sits in the Mobile for Development unit and works towards equitable and sustainable food chains that empower farmers and strengthen local economies. We bring together and support the mobile industry, agricultural sector stakeholder, innovators and investors in the agri-tech space to launch, improve and scale impactful and commercially viable digital solutions. And we do this across three main focus areas: digitization of the last mile, climate resilience and financial inclusion. And we do this through research and insights, which is the side of the team I sit on. And through implementation, we have at the moment an innovation fund through which we are implementing 7 solutions in 7 markets across Africa and Asia. So as Samke already mentioned, today we're going to talk about climate change in agriculture, and I will be setting the scene for the discussion and defining some basic concepts such as resilience, adaptation, and mitigation. We will talk about climate finance and flows of climate finance to small agriculture. And we will see how AgriDFS can increase farmers' climate resilience. And then I'll pass the floor to my colleagues from Yahoo Solution and Satsure to show us how they are applying technology for credit and insurance respectively. So let's start by talking about why we are here today, really, why it is important that AgriDFS for climate resilience. So there are 500 million households out there that rely on small agriculture for their livelihoods. And these livelihoods, of course, we're talking agriculture, so they're highly dependent on natural resources and rainfall patterns, so things that are changing with climate change. Their production is very vulnerable, especially because it's normally, we're talking about rain-fed agriculture. 90%, for instance, of small agriculture in sub-Saharan Africa is rain-fed, but less than 3% of these farmers have insurance. Climate change is changing the rainfall patterns as well as heat waves and pests and diseases for plants. For instance, it is estimated that nowadays we have 20% more extreme heat than in the 90s, and 44% more areas will be exposed to severe drought and flooding by 2050. All of this has an impact on productivity and ultimately on food security. So again, estimates show that we will have up to 30% reduction in global yields by 2050, with peaks of 50% in some sub-Saharan African countries, and which will affect food prices with an increase of up to 20%. So when we talk about climate resilience, we're really referring to the ability of farmers to respond to these changing conditions, recover for these external shocks, and adapt to mitigate the effects of climate change in the future. At the same time, agriculture is also an important contributor to climate change. If on the one hand, agriculture contribution to GDP ranges between 24% in low-income countries to 80% in middle-income countries, agriculture also accounts for 25% of annual greenhouse gases emissions, which have doubled in the last few years. And we expect this to increase further 30% by 2050. So when we refer to climate change mitigation, we're actually referring to the effort to reduce and prevent emissions of greenhouse gases. And this can be done through new technologies and renewable energies, making all the equipment more energy efficient, or changing management practice, like for instance, agricultural practices of smallholder farmers. Of course, to act on all these changes, we need financial resources. And there is an urgent need to increase climate finance flows. This analysis from the Climate Policy Initiative shows that the positive trend of increase here at the bottom of the figure in the last 8 years, with an estimated $622 billion in climate finance for 2019. However, this falls short of the investment needed to actually keep global warming within the 1.5 degrees target. These investments are required between 3.8 trillion and 1.6 trillion, so definitely far from what we have nowadays. When we talk about climate finance, this is quite all-encompassing. We are really referring to local, national, and transnational financing, drawn for both public and private sources that aims at reducing emissions, so the mitigation action that we talked about, and maintaining and increasing the resilience of human and ecological systems, so the adaptation side of the problem. These two graphs show a bit, give an overview of the climate finance sectors, uses, sources, and instruments. But we can see that the great majority of these climate finance flows go into mitigation actions, 93% of them. And main sectors targeted are renewable energy generation, with almost 60% of the financial flows, and low carbon transport. Only 3.6% actually go into land use and natural resources and agriculture. In terms of sources, they come from both public sector, mainly through development financial institutions, both national, bilateral, and multilateral, but also through corporate actors and commercial financial institutions, the green in the second graph. And in terms of finance instruments, it's really focused on grants and concessionary projects and on the public financial flows, whereas balance sheet financing, both equity and debt, are mainly used to provide the private sector. The climate policy initiative in partnership with IFAD also did a deep dive on climate flows for smallholders. We can have an overview here, but it's very interesting to compare the overall financial need of smallholders or small agriculture that has been estimated a few years ago in $238 billion. If we compare how much climate finance gets to the sector, which is 10 billion, you can see the wide gap that still needs to be filled. Interesting to notice that in contrast with the global trend, when we talk about climate finance for smallholders, this are mainly targeted to adaptation initiatives in line with the need to strengthen resilience for farmers. And they mainly come from public sector resources, mainly from grants. However, they're also going into low carbon and climate resilient infrastructure, mainly transport, which is a key barrier for the private sector to do more and to invest more in smallholder agriculture. Of course, being the GSMA in our work, we really look into digital solutions, and we can see the digital solutions play a key role in strengthening the climate resilience for smallholder agriculture. Today, we're focused on AgriDFS, but there are other solutions that are also very important. For instance, weather and climate services and data-driven agricultural services, such as climate smart agri advisories, so information for farmers to be able to act, and precision agriculture, so very localized type of information. If you want to know more about the other use cases other than AgriDFS, I would encourage you to look into this recent GSMA publication on digital innovation for climate resilience agriculture. But focusing on AgriDFS, we identified 4 key enablers that are really unlocking innovative AgriDFS business models, so to reach smallholder finance with credit and saving products. These are, of course, mobile money that is not only completely changing and transforming the financial inclusion as a whole, but also in the agricultural sector. Mobile money providers are increasingly providing bulk payment solutions for agricultural value chain payments. And globally, we have 120 agricultural organizations have digitized their value chain payments. Data is very topical at the moment and is becoming ubiquitous. We see digital procurement solutions that really allow to collect farmer profiles, farming data like never before, and therefore give visibility on procurement transactions and the possibility to estimate productivity and then feed into potential credit scoring and credit worthiness assessment of farmers. APIs that help bridging one of the key issues here, data sharing and information sharing among different partners, contributing to AgriDFS, and remote technology, like for instance, the possibility to lock devices remotely, that is enabling the pay-as-you-go business model that is moving from solar home systems, where it started, into more productive assets, like for instance, irrigation pumps for agriculture. If you want to know more about all these models, so we have an upcoming publication that should come out at the end of the month. They will explore more in detail digitization of value chains, embedded finance platforms, and pay-as-you-go models. And we feature all these different organizations in the publication. But today we're really focused on how AgriDFS can play an important role in climate resilience, both for long-term adaptation and short-term responses. If you think about agricultural credit in the short term, can really help farmers access improved inputs, improved fertilizers, have less impact on the soil, or drought-resistant crop varieties, for instance. But also long-term loans for investment are quite crucial for farmers to adapt their productivity and agricultural practices and acquire and invest in irrigation, or for instance, cold storage units to reduce food waste. And also on the other side, agricultural insurance, so that is seeing an increased use of digital sources, data, and satellite as well. And now then I leave the floor to my colleague, Davide from Yeko Solutions, to discuss about agricultural credit. Thank you.
So Thanks a lot, Sonia. Can you hear me well?
Yes, and I'm trying to stop sharing so that we can share.
Yes.
There you go.
Super. So I'm going to share my screen. You see my screen, correct? Super. Okay, so first of all, thanks a lot for the opportunity to participate to this very inspiring webinar, and thanks a lot to all participants to be here. So we'll try to grab the opportunity I received to speak with you for 10 minutes to tell a bit what YAPU does and how do we approach this huge problem that, to be honest, is one of the biggest problems humankind have ever had. How do we adapt to climate change? So that's a bit the outline. What is YAPU? What's the relation between YAPU and climate resilience is some example. Yeah? So what is YAPU, first of all? So YAPU is a German group. It's based in Berlin, and we are present in Latin America and Sub-Saharan Africa. And our main scope is to provide flexible software solution to support the operational process of institutions. So basically we target the digitalization of institution because it's like a key entry point to start then working with data, and also to reduce the operational cost of the institution that want to engage in climate change adaptation or have to engage in climate change adaptation, with main target smallholder farmers. So the institution that want to finance or refinance smallholder farmers, but also micro enterprises, small and up to medium-sized enterprise. We do that through basically three main services. One is the software that I'm going to spend some minutes to tell you how it works. And then other one is about advisory services and research, working with data to understand what works well and what does not work. Couple of examples of implementation, where we have been active, just some words. We've been working in sort of a hybrid model where our clients are direct financial service providers, so local banks of microfinance institution, or our clients are some international banks, you see some names here, or are international organization. Yeah? So our main focus here, as you can read the projects and you can go through them, is really to try to support in various regions of the world smallholder farmers to adapt to climate change, and to support financial service providers that want to better understand the climatic risk of their clients and then try to find solutions. How do we do that? So normally, this is basically what we used to offer. So we have digital process management, as said. So there is a really full-fledged offer where we basically reach to an institution and we digitalize their processes, so that then the main target is to reduce their operational cost and then to improve their capacity to manage the risk. There are two offers. We will say two things in a while. So we digitalize the full credit process, or we provide an additional interface, what we call a platform, where basically the institution can keep on using the usual tools, but then it can log into our platform and receive a specific analysis for the agricultural sector, basically with projection of cash flow, climatic risk indicator, environmental risk indicator, and validation of climate-proof practices or technology. We also have a part on consulting, as said, that we're focusing about project implementation and development, focus on climate change adaptation and green and agri-finance. And then we work on data services, as said. So there is where really we try to work on the data that we receive to improve the capacity of the institution to take decision, to include, to foster inclusion of smallholder farmer with main focus, at the same time by reduce the risk of the client and of the institution. So what about YAPU and climate resilience? That's a bit, let's say, the concept that we use to manage when we speak about climate vulnerability, and then as a consequence resiliency, to decrease this vulnerability, is that we see climate change, of course, as a result about an exposure. Basically is the threat, climatic threat. Yeah, it's raining a lot, it's raining more than normal, or is warmer than usual. That's, you can basically not doing nothing at the short scale. You just need to start mitigate to reduce this impact at medium term. So that's typically is not something that we can manage at the level of a long cycle. And then it's about sensitivity, because you would like to know how much are you sensible to a certain exposure. Very simple. If it rains and you are in the office, you will be much less affected than if you are in the field. So it depends which activity you do and which kind of inputs you use. For example, which kind of crops. And then it's about adaptive capacity. And adaptive capacity is how adapt is a smallholder farmer in this case to basically reduce the impact that it could have a certain climate threat. So for example, if you're using drip irrigation, if you're using diversification of culture, if you're working in agroforestry, you will be much less affected from the droughts if instead you are just depending on rain and you have just one monoculture, etc. So where we work more is to help the institution to understand the result of the climate vulnerability, as you know, the composition of the exposure of their client to climate threats, the sensitivity of the crop the smallholder are managing, as well as to better understand, that's the most difficult part, the adaptive capacity in place of the client, so how they are resilient to an eventual climate threat. So by doing that, we work with institutions to manage their climate risk portfolio, but at the same time, to support the institution to manage the client risk. So basically not only try to reduce the risk an institution has its own portfolio, but to try to reduce how exposed is a client to certain threats by basically support the institution to find what we call nature-based solutions that are basically products that aim at once to improve resiliencies to climate change and then decrease impact on the environment and improve productivity. Now, 2 words here, because that's, I think, is key. That's a concept developed by the Green Inclusive and Climate Smart Finance Action Group that I lead for the European Microfinance Platform. I can tell you more if you're interested in, but it's very important to think when you think about the green products, services, or products as a way to basically achieve at least 3 main objectives. One is to reduce client vulnerability, that's what we speak here. At the same time, reduce the impact on ecosystem. That's extremely important as well, because there will ensure higher and better, more sustainable productivity. And then, of course, increase quality of production and quantity. So basically to make a business case. Yeah? So that's what we pursue in YAPU as well, being member of this action group. Now, what we offer to each institution that want to work with us is a set of these indicators that if there are questions, I can explain more. Is about climate sensitivity, how sensitive the production of a smallholder farmer where a financial institution want to provide services or loan or finance to. The adaptive capacity, so how adaptive will be a client to eventually offset a climatic risk. Certification of the credits, verification, sorry, if the practice or technology a smallholder farmer is implementing is a nature-based solution. By nature-based solution means is able to reduce the eventual climate threat. And then indicator that has to do with the verification of biodiversity conservation. So how the activity of the client finance or in the full farm are going to potentially affect the biodiversity and then his food security. And then there is an automatic projection of cash flow typically. So you know the geolocation of the client, you know the crops and the variety and the techniques that the client used to, the smallholder farmer used to implement. And then our software can project automatically the cash flow of these crops. And of course, about climate exposure, what I will try to use my last 2 minutes to tell you something about, but basically using geolocation and mixing with satellite data to see, okay, how likely would be that your client will be affected by climate threats. This is how we do normally. So we, during the loan assessment, how we integrate the various sources, yeah, from the data collection till the risk assessment, till the verification of which product has been financed, and then also the follow-up that the implementation of this nature-based solution has been done in the correct way to, you know, to have a certain probability that you have positive outcome for resiliency. This is said, we offer 2 software, 2 options, digital and YAPU platform. Yeah, so digital, we transform the process of the institution into digital, and we include this indicator in terms of risk management, the verification of product, as well. If the client come with us with advisory services, we also teach them how to develop specific product, how to include this risk into risk policy, or the YAPU platform, as said, is like an interface where you can basically plug in and have automatic cash flow projection, risk indicator for climate and verification of practices. My last 40 seconds is about, yeah, that's the visualization, for example, of the risk in portfolio you can have, so you can manage ex ante the climatic risk. And maybe let me just give you an example, yeah. This is an example we implemented of Project Mabel with United Nations for Environment. They just want you to see that there is clearly a demand for that. So we started 2012, actually YAP was implementing that 2018. It's about really managing climatic risk for smallholder farmers. Here you see the number of countries, number of institutions, and how it's scaling lately. So interest and engagement. And then I just want to say 2 words on this and I close, because I think it's the nice linkages with the next speaker. We provide services to basically use external database, things satellite, imaginary, to basically use the geolocation of each client that the loan officer gets when make an interview to a client, and to match them to maps, protected area and climate threat, as well as potential projection, to then give an estimation, to the loan officer of how affected could be the production of the smallholder, B, to suggest which kind of practices and technology the smallholder could use to offset part of this threat, and then basically secure the loan and secure that the smallholder will start producing better and more. So basically offset ex-ante climatic risk. And now, without further induction, I want to pass the microphone to the next speaker that basically will tell us that no matter what we do, there will always be a risk, and you also need to offset the ex-post risk. So what is going to happen? What can you do once then you have a huge or an important climate event? So about insurance. Thanks. Abhishek, the floor is yours.
Thank you very much, Davide, and thank you very much, everyone, for joining us this afternoon. Afternoon for me, must be different time zones for you. Thank you very much indeed. So when I was asked to present my thoughts about, climate resilience from an insurance point of view, I had 2 choices. Either I could make a pitch, talk about my company, talk about what we do, or I could tell you some stories. I've decided to tell you some stories because I think that's, you've already heard too many pitches, and some stories are always welcome. So a couple of things that I wanted to talk to you about is, while climate change is real, the impact of climate change is felt by the people who are least responsible for climate change, the most vulnerable people, the most vulnerable populations of the world, who live in least developed countries, live in difficult situations, some in poverty, most in poverty, and the most predominant occupation for people in these countries are agriculture. It's still agriculture. More than 70% of the human race still depends on agriculture as its primary source of occupation and livelihood. And the impact is felt by them. And if you see how agriculture works in some of these developing countries and least developed countries, most farmers inherit their land from their families, from their forefathers, and they use traditional knowledge to do their farming activities. They would have learned something from their parents. Their parents would have learned it from their grandparents, etc. With climate change, with seasons changing, with biodiversity changing, with climate changing, suddenly a lot of things they learned from their parents, from their grandparents, don't work anymore, which leads to drop in productivity, drop in yields, increase in pests, unpredictability of weather, so on and so forth. It just puts them in a vulnerable position, because since they're doing most of their farming activities using traditional knowledge, they really don't know what to do. And most farmers end up suffering the perils of climate change, as they lose protection, or they lose their livelihoods, which are not protected. The insurance industry is always very quick to react to risks. There is always a new product coming up. Crop insurance has been around for many decades now. In the Western world, where there are large farm holdings, corporate farming, and industrial scale farming, crop insurance is a must-have. I don't think any farmer in the West is not having crop insurance. Either it's given to them through government subsidies or they are buying it commercially. But the same is not true in developing markets and least developed markets. It's for multiple reasons. One, the way traditional crop insurance was done was, they would look at, yield loss, etc., and there would be a huge, operating element to it, where somebody had to go and verify if there was a loss, and then, settle claims, etc., which was a very cumbersome process. Because it was a very cumbersome, human-intensive process, the whole insurance value chain was expensive. Running the value chain was expensive. Everything from underwriting to policy administration to settlement of claims to verification of claims, etc., was an extremely time-consuming and expensive process. That left, the impact of that expensive process was reflected in the premiums. The insurance industry obviously saw that these models will not work for smallholder farmers or farmers in developing and least developed countries. And then they came up with what is called as microinsurance. They said, let's cut out all the fancy stuff. Let's give a bare bones, simple to use solution. It did work in a few places. It had its own set of challenges. With technology and data being available, more often and more frequently and more reliably, insurance went from being, a area yield kind of a indemnity-based solution to, index solutions, parametric index-based solutions. That still didn't answer everybody's question. There were questions of exclusion. Not everybody could still access it. There was a knowledge gap. How do you communicate to a farmer what he's getting, on what basis does he get paid, if the entire thing is very, very abstract? What is insurance after all? It is a promise to indemnify someone or promise to pay if somebody suffered a loss. So these concepts are difficult to understand. While these are all challenges that the insurance industry is trying to solve, I think technology and data has made this happen to a great extent. And I won't say it is a problem that is solved. It is still under solution. So today, with remote sensing, with so many satellites that are available, with the ability to look at a single farm and activities on a single farm on a near real-time basis, companies are able to determine the risk faced by a farmer at a very, very micro level. There are products being designed for mitigating those risks. But what is still missing is complete inclusion. We always talk about smallholder farmers. What about shadow farm workers, farmers who don't own the land but who are working there? How do we protect their livelihoods? I think we need to look at things from a holistic point of view. While smallholder farmers are vulnerable, shadow farm workers are even more vulnerable because they don't even have land ownership. In most countries, because of lack of risk management in agriculture, farmers don't end up getting access to credit. And I have seen examples where access to insurance has unlocked access to credit for a lot of these farmers. And I think we need to look at that very carefully. We also need to look at globally, from a social point of view, how do we change our inheritance laws so that more women get land ownership rights, and then they are also able to farm in these lands and then secure their livelihoods. And in the interim, while those long socioeconomic changes happen, how are we solving their livelihood protection problems? And I think data plays a very, very crucial role in all this. We as SASHURE try to find opportunities by looking at data, looking at how can we create new solutions for inclusive insurance, how can we work with governments, intergovernment agencies, private insurers, even farming communities in designing better products. So we've done various projects across the globe with different agencies. Some of them have been successful. Some of them have just been great learning experiences. And I think we should continue on this path of data-driven decision-making, which we call as decision intelligence. Use decision intelligence for making smart choices in the way we design products, in the way we administer products, and in the way we create impact for the most vulnerable people on this planet. Absolutely, there is a lot of statistics. One Google search will give you so much statistics that you'll probably need an entire lifetime to digest all of that. But a human tragedy is not a statistic. And today, climate change creates human tragedies. A lot of people are driven back to poverty from where they were before. And I think it's important that we stop that. The only way we can do that is by creating inclusive products, by using data-driven decision-making better, and by solving problems for the most vulnerable people on this planet. And that's my story. Thank you.
Thank you so much, Abhishek. We do have some questions in our chat box, and I think what I would like us to do is give an opportunity for David to go through the role of microfinance institutions that he was starting to explain, because that might answer one of the questions in the chat box. And then we have other questions as well as in our Q&A. But David, maybe you can just go through your section at the end a little bit more and give us a bit of detail when it comes to implementation, and then we'll move on to questions.
Yeah, thanks a lot. So what I would like just to share, as Abhishek, this is sort of a story, if you want. So the main topic we have about financial institutions is that, of course, we have a problem to finance farming, specifically smallholder farming, because there is a risk that they're not able to evaluate. And if you are a financial service provider, you will know that if you are not able to assess a risk, you will put the target so high that probably that will go out of your target market. So the risk is infinite or is too big. That's typically what banks used to do with smallholder farming. Yeah. So there, first of all, you need to be able, and that was questioned by Todd, to understand the cash flow projection. So you want to know how in a given location, the crops that are cultivated by a farmer are going to generate revenue. So which cost and which revenue on a monthly basis or on a weekly basis, then depends on your currency. And then being able to match your product to the client need. This specific exercise that seems to be quite simple, in general, is still at the very beginning of microfinance. When you try to refinance, clients know their cash flow. But then you need to consider an additional complexity, that is, this cash flow is an hypothetical cash flow. So various things can happen because now climate change could hit the client. And typically microfinance institutions have no idea how that could impact this cash flow. So you will say you have 1 hectare, you're going to produce 3 tons, and normally 3 tons will be sold at this amount, and then you establish your loan product around that. But of course, climate change could affect this cash flow, could make it half or destroy completely. Yeah, and as well could affect the cost or the price at which you're going to sell your crops. Now, what we try to support, and what I think is a key role about digital service provider, is to understand what is the cash flow ex ante, so before giving a loan, what is the reliable cash flow of various smallholder according to the kind of crops they cultivated, where they are, which practices, and which technology they use. Now you try to do an ex ante evaluation, so you have a cash flow projection. You try to then basically balance this cash flow projection with what will happen, how this cash flow will be affected if there is a drought, if there is too much rain compared to what is normal, because that is going to come more and more. And then you try to do 2 things. One, to include this risk into your lending decision, to say, okay, I keep on financing these things because it's been going very well so far, like rain-fed monocrops, but now probably that will not be so good. Yeah, and then you try then to better finance practices that instead are more resilient. Yeah, first of all, you try to scope that within your portfolio. That's kind of choice I want to stress that typically is inclusive, because normally the reflection you have is, now you measure climate risk, and so then basically you're not going to finance no one. Instead, it's very much the reverse, because you start measuring that. So you start understanding how much is the risk. Remember, you're a financial institution, so typically the risk is infinite if you don't know what the risk it is. And second, when you start thinking, I need to diversify, I need to find strategies to produce more than one crop, etc., you will discover that smallholder farmers per se are more resilient, because typically if you are financing monocrops, and that's typically is bigger farming, first of all. And second, you try to proactively, and I close this, but I think it's an important point, you try to proactively generate resiliency. So not only try now to finance what is already more resilient, but try to find a way with non-financial services, for example, training, capacity building, ongoing support, generating, ecosystem with the training of farming training through cooperatives of producers, etc., to basically explain to the farmer how they could do their production better. Yeah, and so you try then to finance the kind of production like drip irrigator, agroforestry, diversification of culture, etc. With United Nations for Environment, we developed a list of 40 solutions called ecosystem-based adaptation, for example, that are per se more resilient. And then I close my intervention. But in any case, no matter what, it could happen that you have a disastrous event like a tornado. Yeah, and no matter what you do, yeah, you are going to lose part of that. And there where I think the part of insurance come in that really complement this ex-ante cash flow projection, including climate change, to say, okay, and what happens now if there is dramatic events? Yeah, and this kind of matching between ex-ante cash flow projection and ex-post, if a tragedy happens, is what we think we need to go through, because this is my perception. Insurance should insure things that become clear to be sort of a dramatic event, so that also will be easier for smallholder, but that is only possible if ex-ante we are able to offset the basic problem. That is, let's not keep on doing things that are by per se, if it rains 2 liters more or 2 liters less, you will lose half of your production. So that's I hope I clarify a bit. Yeah, I think Abhishek was happy, so I'm very happy.
No, I love your answer. It's fantastic.
Yeah, I see Abhishek was nodding fiercely. It was really technical for me. So I was struggling to follow there, and I hope, Todd Harrington, you've been answered on your questions, because I find that David went into quite some detail. So I think even your second question that I thought you asked whether YAPU considers the same, and it looked like David answered you. So maybe I will go on to some of the questions that we have concerning index insurance. I'm not sure if we got a very good definition of what index insurance is. And I'm wondering, Sonia and Abhishek, if you two could maybe give us a definition first, and then answer the question on whether index insurance is sustainable financially for the financial provider.
Sonia, would you like to go first?
Well, I guess you're the expert on insurance, but what I can say is that, as you were also summarizing before, there has been this shift from an indemnity approach, individualized approach, to this index base, in which we use data or remote observations to create an index. For instance, in a certain area, what is the rainfall that can be expected in a certain period of time. If this rainfall is too low for our crop, then this change in condition would trigger a payment. But I'm pretty sure you can provide many more detail.
Yes, look, definitions are not important, right? But it is important at the same time. So there are lots of textbook definitions. My simple answer is, if you're able to use data which can directly correlate to an event and pay out on the basis of that, or trigger payouts on the basis of that, that to me, very simply put, is an index solution, right? Parametric index solution, because there are your parameterized data, and you're using that to make payout triggers. Your question about, is this sustainable for financial service providers? Absolutely, because one, there are two elements to it. Risk management is risk management, whether you do it on a parametric basis or on an indemnity basis. The principles of risk management, the principles of portfolio diversification and finding reinsurance and further capacity, that does not change. However, what is interesting in a parametric insurance or index insurance context is the cost of administration is very, very low, right? You don't have to send people physically to the location where the peril has occurred to assess the quantum of loss. And then you don't have to get into discussions around whether it's a 50% loss or whether it's a 45% loss or whether it's a 65% loss. Those subjective differences can be eliminated because the payouts are based on a trigger which is administered by a neutral third party. It could be a weather service provider. It could be a local weather station in this village. If the temperature raises beyond a certain threshold, there's a payout. Or if there is in the local rain gauge, if the quantum of rain is beyond a certain level, there's a payout. If there is no rain, there's a payout. So the product designs are simple to administer and simple to challenge. Either somebody gets paid or not. Obviously, this system is not completely free of flaws. There could be a lot of false positives and false negative triggers that can happen. Obviously, somebody who's gotten paid when they didn't suffer a loss will not complain about it, but somebody who's lost something but not got paid because there was no trigger would obviously have a problem with that. And that is where data-driven insurance design comes into play. When you look at historic data, when we constantly keep improving our algorithms, over a period of time, the number of false positives and false negatives from a trigger point of view can be reduced. And we have to just, let it run its course, learn, improve, fix, and continue on that cycle until we have better algorithms, and that's the way to do it. So from a sustainability point of view, yes, the cost of administration is dramatically reduced. The cost of litigation is dramatically reduced because there are not that many subjective assessments, and because the costs are low, you can get volume, you can insure more people, so on and so forth. So that's a short answer to your question.
I mean, okay, in the absence of questions, I'm going to indulge myself a little bit here. When you guys are discussing data and the availability of data in the space of where we live in now, where climate change means that there are so many more unreliable events in terms of that affect, productivity of farmers, etc. That would certainly mean that data, to me, it's seeming like data is increasingly unreliable. But you're speaking of algorithms and a way of standardizing how we receive data. So, how do we overcome the challenges of making climate resilient products and services standard within financial products and services, or incorporating them in standard financial products and services? What does the future look like when we are facing really unpredictable weather patterns impacting productivity? It sounds like there is a science, but the science to me is sounding very much like it's at a very undefined phase. Excuse my question, but anyone can go for that if they can understand what I was trying to say.
Maybe I just spend 2 words. In Yapu, we used to say that we don't need to employ the high technology, but the right technology. So it means that sometimes, we think, everything we state and we will aim to do here in this panel, and I think the participant is totally correct. But if we start from reality approach, basically it's really a black box. So we don't know what the climate risk is into cash flow projection. Normally, the 95% of the institute that finance smallholders, they don't know it. So the first thing you try to do is to generate with the simplest way as possible the consciousness that there is a hidden climate risk into what we finance, because it's anecdotal for them. And for that, you don't really need a huge amount of data. You just need enough reliable data. For example, with Yapu, we start to use the FAO data. We're classifying 2,000 crops about their sensitivity to change in temperature and rain. It's very much not exact on geolocation, etc., but it's extensively covering, crops and variety, etc. And that's just, a score that you can give to each kind of crops to understand how likely it would be that will be affected by a possible event. So you don't ask anything, you basically don't harvest anything, but systematically you include in any kind of loan assessment the climatic risk. Yeah, the guy now is going to telling you, I am cultivating 1 hectare of maize, and now you don't only have, normally producing 3 tons, but it's also telling you, yes, that as X percentage, vulnerability from 0 to 100% to an eventual drought, to an eventual flood, for example. And that is very much not correct, but it's very much a lot, because typically you don't know anything. And I think is a key starting point, because then it starts becoming the normal mechanism of each financial institution start thinking, okay, but what is the real climate risk? And then when you start digging into data, let me try to have this assessment more correct. So how much I'm gonna lose now if there is, a drought or a flood, And then after you do that, so we really need to harvest data, including data. There is a cost, there is technology behind. There is the topic that Abhishek was clearly saying extremely correctly. Now you need to learn from what is happening. So now you have some working hypothesis, and now after 1 year, for example, you will see who repaid the loans according to which condition, and then you adapt your estimation. But it's really a process. You start extremely simple with basically extremely few data. We say tending no data, but to generate consciousness that there is climatic risk and possible resilience to build. And then you start slowly getting in data. Why that? Because there is a huge wall to overcome. There is everyone speak about climate and climate change, but very few are really trying to do that. And we believe is a huge step to do. And when we arrive with data technology, we keep on maintaining this perception. And people listen and say, that's very interesting. But it's not so difficult to start. It's difficult to refine. But to start is pretty simple, because we are at 0 in general. So now we do a first step, we already have 80% of the solution. And then technology, as I think the other speaker can really support me, clearly exists. Now the point is, how do you make it usable? But that exists.
If I can add and maybe get even more back to basic, I mean, Samke, when you say data seem to be inaccurate, definitely they might be inaccurate in one point in time, as David was saying, the moment we start, but then take it as a process. So actually it's several rounds of data, and then as Abhishek was saying, you model and you get into more accurate, less false positive and less false negative. For instance, the main model that we are at GSMA we are implementing in our innovation fund is the digital value chains. And what we see when we start to create partnerships is that typical financial service provider would like to see 2 to 3 years of data, or even more than that, of different crop cycles before having a bit of assurance and visibility on the actual procurement and payment processes before actually starting engaging with giving financial services to a farmer. So it's more of a process, so you need several years of data, not necessarily one point in time to be able to model.
That makes sense. That makes sense. Thank you, Sonia. I'm glad that Sarah put in the chat about our course at Digital Frontiers called Digitizing Agriculture. It's a 4-week course, and it is quite simplified. I think a lot of the people on our panel today are experts, and so sometimes the language may go above our heads, especially I know that some of my colleagues that we did a lot of conservation work with will find the financial aspects challenging. But if you start with that Digitizing Agriculture course, you'll really get a sense of the language moving you into understanding some of the concepts discussed here. I think we've got space for one more question, Sarah, and then I will hand over to you to do our closing. We've got a question from Som Tuhe, and apologies if I mispronounced your name. The question says, these digital financial services for climate resilience look compelling and logical. Do any of the presenters have a view on how capital is flowing to companies providing these services at scale? Is it improving, or do big barriers still need to come down to enable the sector? That's a great question. Some closes that off by saying that I see that many investors are happy to invest in an MFI doing the same old business, but are not comfortable investing in companies reducing risk and adding important value in the agricultural value chain. So short answer, please, panelists.
I can go if you want first. Thanks first of all for the question. Is very compelling. I think my view is a bit different. I work both. So I'm heading this action group. I post there the link, and we're working more than 135 members that are private investor like banking, but also international institute, academics, etc., etc. And we feel more and more the pressure to finance what can green the portfolio or to finance what can reduce their own climatic risk. So there is a huge vague for that, and we are keep on hearing we need to find the right opportunity. So that's the willingness and the amount and the finance flow is not missing. Now the point is how to make it happen. For example, organizing events to match demand and supply. So what a financial institution would need, to get more into this direction, and what can provide as a KPI, so as performance indicator that is doing the right thing, is really greening the portfolio, is really reducing the climate risk. Yeah, and then the same thing we have been asking to the investors, and then we need to try to find the match. Typically, it's a question of dictionary. Yeah, what one wants and what the other would like to do. But please, if anyone here is a member of microfinance institution, believe me, there is a huge opportunity to grasp, because everyone feels the pressure to green the portfolio, to generate resiliencies. There is a lot of cheap funds that are coming also through the balance sheet in blended finance or directly to private or public investor. And there is a lot of regulation going on specifically for European actors. They need to start complying. We need to do not waste the environment. We need to generate resiliencies. So they're coming. So whoever of you thinks can provide this kind of product, just raise their hands. Also write me. I'm happy to put you in contact with the one that could be interested to look into what you would like to do. Yeah, it's really a question to make linkages.
Yes, we've been also starting looking into exactly this financing flows from investments. And at the moment, it seems that when we talk about pure commercial investors, they still struggle to see a return and to measure the return. So that is why we saw before a lot of climate finance at the moment still comes from public sources or this development financial institution, and then go probably into the programs that David was also mentioning. But yeah, so there is still, now there is the urgency, but there is still some work to do for pure commercial investors to see the opportunity and be able to measure it and to see the actual returns out of it.
Abhishek, is there anything you want to add to that before I wrap up?
No, I think our more experienced, learned co-panelists have covered everything. It's fantastic. There is indeed a lot of global push, both from the private sector as well as the public sector in climate resilience financing. I know that there are many insurance initiatives focused on climate resilient insurance and inclusive insurance, which is becoming mainstream. Sustainability is at the core of everything. So sometimes sustainability can be expensive, just like renewables, right? When renewables just started to replace traditional energy sources, it was very, very, very expensive. In some parts, it's still expensive, based on the solution. But over a period of time, the costs are rationalized. I think we are at that stage in climate finance where pure climate resilience financing is expensive, but over a period of time, through regulation, through incentivization of different players in the value chain, there will be a rationalization, and it's all happening as we speak. So I think in our lifetime we can see all this happen. Exciting times, not so exciting times, because climate change is horrible. Nobody likes to have these extreme heats, extreme unpredictable rains and things like that, and definitely not our farming brothers and sisters across the globe. I'm sure they are suffering a lot more than any one of us. The best way to solve their problem in a tiny bit way is by creating financial solutions to ensure that if they do suffer a loss, they have a backup plan. They have something that will, protect them from it, or they can, pay their way out of it, to very crudely put it. So that's my submission. Thank you.
Thank you so much. And thank you, panelists, and also thank you, attendees, for joining us today. It's been a really fascinating conversation over the last hour. Abhishek, as you were just saying, smallholder farmers already have a tough life, with often low and irregular income and physically challenging work. So these extra climate risks and climate change that is happening for sure is putting more pressure on them. But it's really good to start thinking that digital has actually is actually allowing us to bring some change. So as Sonia said earlier, things like mobile money, data, APIs, remote technology, they are giving us opportunities to actually sort of relook at and think about how we're going to offer our digital financial services and products in a slightly different, more efficient, more effective way, which ultimately will help both the farmer themselves, but also the financial service provider to kind of manage the risk when it comes to things like credit or paying out an insurance. And I think that financial resilience is going to be even more key for smallholder farmers as we go on. And I'm so encouraged to hear that we are seeing more people willing to invest. Yes, it might be in the forms of grants, but I think I very much agree that we're seeing more and more people coming under pressure to sort of think about greening their products and services. And as you were saying, as the cost comes down, the business model starts to make sense for more people. And actually some of the work around credit and insurance is so that the volume is the game, right? So hopefully that will help with these business models and enable green financial digital products and services to be provided by more people. And of course, we also have more regulation. That we didn't even manage to talk about regulation today. I'm sure that could be an entirely different topic for another webinar. But as that changes as well, that puts extra pressure, which is what we really need, because climate change is happening, and for sure we need to kind of do whatever we can to be involved in trying to help manage financial resilience and risk. Thank you very much. What we're going to do is send out the recording, and we'll also put in that recording a way you can reach out to David, Sonia, or Abhishek to continue the conversation with them if you would like. And do look in the chat, because if you're really interested in this webinar, David has shared a second one you can join right away, right now, to further your knowledge and conversation on the issue. Thank you so much, everybody. I wish you all a good day or a good evening, wherever in the world you are. And I look forward to seeing you all in a webinar again soon. Bye, everyone.
Thank you.
Thank you a lot.